Silver standard is probably better for humanity. It is the original money standard, which could mean, by the logic of what money is, going back into the past in the regression theory, the regression theorem, or the regression principle, whatever you want to call it. If civilization started with a silver standard, then arguably we're still on a silver standard that's just covered up by a gold standard to pretend that silver isn't really there. Is silver really the more liquid commodity, and it's just being suppressed by legislation that gold is the money since 1871, and therefore that's artificially lowering the demand for silver and making it look less liquid? But if gold and silver were on equal footing and you could use either one for money, would silver really be more liquid than gold? That's the question. When gold was still relatively new, or mining technology was still pretty primitive, and they just didn't have enough gold, then when somebody came upon a big deposit of gold somewhere, and that just required like a pickaxe or something to find it, and then there'd be a huge supply addition to gold, then its price movement would be pretty large, because there was a small stock and then you're adding a lot, and like you find these big things in chunks. Whereas silver was still more liquid, and so you could have a big shipment of silver come into Europe, and the price of silver wouldn't change that much. So silver would be the money, whereas gold wouldn't be. But at a point where technology becomes good enough that the supply of gold is increasing much faster, then maybe there is a point where gold becomes more liquid than silver, and gold becomes the money. I think we're still on a silver standard because, okay, so there's this point where technology comes to a level where importing gold isn't at such an extreme level, or finding it in spurts and changing the price of gold relative to silver so quickly. But that's really it's a very temporary island, because once society reaches a point where it's increasing goods and services at a rate where the value of gold is going up a lot
constantly,
right? And then people become really nervous about holding gold, or holding it in their pockets, or using it as money, because it just becomes too valuable, and it's no good for a retail level at all, right? And in order to use gold at all, you need a substitute, you need paper, you need some kind of a derivative, or else you just can't use it. So I think in that world, I think we're in that world, and you'd have to go back to a silver standard just for safety's sake, right? Yeah. So I don't think there's actually a scientific calculation that you can make to determine when we are debt saturated. It's when this equation or this over that value equals X, and therefore we're saturated. And then we get back to the problem of like animal spirits again. Like, what is the point? Like, when does it happen? Is it just like people become too poor, and then I don't think it's that. I don't think it has to do with being poor. It really, I don't know. I don't know what it has to do with.
Well, what I would say, I can't imagine we have 10 or 20 years, because the debt has to grow at an exponential rate. Mm-hmm. We're already people are already we're putting on like $1 trillion every 90 days now on the Federal Reserve balance sheet. National debt, Treasury debt's going up $1 trillion every 90 days. So, and that's one section of the debt. So I just can't imagine. I can't imagine.
$1 trillion every 90 days. And we know that the rate has to keep accelerating, right? It has to keep increasing. And so at some point you just go vertical. So I guess you could pin it down with some kind of equation if you can find something that fits a curve. And I've tried that before. And then it's interesting, and it's like, oh, well, I can draw the curve this way, and what's the equation there? And so I get to but like, we're getting close enough anyway that I don't need to. I'm talking about people flooding into gold. I don't see that yet, which is a good thing if we're talking about how far this rally is going to go. If we're looking at the percentage premium for American Gold Eagles, which is, I think, one of the most popular coins. We see the spot price here is recorded as 2075. I think it's actually 2091. It depends what contract you're defining or calculating on. So it says the coin here, it's an average of $2,201.70. And I think this information is taken from Monex or something. And we see here the percentage premium is 6.11, and it's been going down since the beginning of the year 2023. And I think this little thing here, I think that's just an error. So it's down from about 10.3% to 6.11%. We haven't seen much of a spike yet. So yeah, it doesn't seem like people are flooding into gold. I think it means that there is higher demand per capita, or for the sales that are being made. There's higher demand for the spot price than there are for physical. And there is for physical. So people are the ones buying spot are willing to pay a higher premium than people who are paying for physical gold. They're not willing to pay as much. So on the analogy of market clearing, let's say all these financial jobs, or the Wall Street built on piles and piles of derivatives, mountain on top of it, mountains. When the market clears in hyperinflation, all of that reaches its market value of close to zero, because there will be no demand. There will be no demand for any of it. And so you have the situation. I'm trying to work out how it could even clear itself. We've had all these people, thousands and thousands of people, that a day before or a week before, they were insanely powerful and they had all these connections. Now, I mean, hyperinflation, hyper and deflation are really both two sides of the same coin. They're really the same thing. It's just what unit you're going to use in the end. So if that's true, then this depression should be just like the Great Depression, except instead of people trying to sweet talk people with pieces of paper in their pockets, they're busy trying to sweet talk us. Even in the late 1970s, when we were in our last monetary crisis, the debt levels were very low.
Yeah.
I think they were at two. I think they were like 25, 30%, something like that, during a monetary crisis. So we have the next monetary crisis with debt levels at 130%. It's going to be much worse. There's probably more than two, but there's two that I'm thinking of, factors that can really complicate this. One is that, let's say in the 1920s and 1930s, the communication was like basically phones and telegrams, and that's it, really. Like if you wanted to talk to other countries, or to communicate overseas, but now everyone's communicating overseas at all times with everything, with WhatsApp, or so much more stuff. Everyone's talking to everyone, and there's the internet
overseas right
and
now.
and that how does that, the cost to maintain that communication infrastructure could just be too much for the world to handle, and all of communications could go down for a while, or for more than a while. And that would really create economic chaos, because all of the economic connections are based on these instantaneous communications, everyone with everyone. And the second thing that would really complicate things is that the geopolitical order, right, that would fall apart. I mean, people think that America's holding the Middle East together, and it might be in its current form,